will be happy to answer questions in both official languages. Alors, avant de poser vos questions, s'il vous plaît, prière de vous identifier. Je vous demanderai également de poser seulement une question et une question de suivi. Governor Poloz is now ready to take your questions. So, Mr. Spicer.
Exactly what outcomes specifically would you need to see to put you back into easing mode?
So, yes, what we said back in January was that going into that set of deliberations, there was a bias towards easing. We hadn't decided to ease or anything, but it was clear that we were dealing with some significant negative shocks to our outlook, and that it would delay significantly our return to target inflation and full capacity output. And so, however, it did appear at the time that the fiscal package from the government would have a meaningful impact on that analysis. And our convention is to wait until such things are actually announced before we incorporate them. So that put us on hold at that stage. And now our updated version with even more negative shocks incorporated in it from the fundamentals, those negatives were more than offset by the fiscal package by adding about 0.5% to GDP this year and a further 0.5 or 0.6 to GDP the following year. Gives you around 1% on the level. And that's, in that story, that's pretty significant. That gets us to full capacity and inflation sustainably on target, we believe, somewhere around in the second half anyway of 2017. And so that's a balanced outlook. What would it take to get us back into the bias towards easing? Well, it would be another negative shock, but it would need to be obviously a shock which is of some significance. Or an accumulation of other shocks, something that meant that there was a significant delay in that process of getting the economy back to full capacity and inflation on target. That's one way to measure it. It's either size or how long the dynamics take for it to close up again. But I can't obviously forecast that. We don't forecast shocks. Shocks happen to us, but it would be something like, it could be some event in China, for instance, that causes global growth to be downgraded significantly again, or it could be possibly the U.S. economy falters. None of these things are in our forecast, but those are just shocks that economists think about.
No, I have a follow-up. Kim?
Hi, Kim.
Thanks for taking these questions. What I'd like to ask is about, you mentioned in your remarks today that one concern with regards to trade is protectionist policies. That that's something we will see, and I'm wondering if you could expand a little further on that. What are your concerns?
The WTO monitors these things, and they've monitored quite a number of, I would say, technical actions by various countries over the past 5 years or so, since in the post-crisis period. Usually, they're viewed as not actual protectionism, but they have that protectionist effect. So they may put in place administrative processes that weren't there before, or new requirements on criteria that must be met. It could be, for example, it could be a safety requirement, which we'd all support, a safety requirement. But it has the same effect as a protectionist barrier if it changes the landscape to someone that's exporting. So there's quite a number of those, and scattered around lots of countries. So I'm not saying there's a protectionist wave. There hasn't been. It's actually gratifying that we have not had a lot of type moves. The G20 has declared in each of their communiques that we will not engage in protectionist measures, and I think for the most part it hasn't taken place. As I said, just some small things that kind of have that effect. But the longer the economy remains in that kind of less than satisfactory stage, there's always a vulnerability on that front. And if you read your history book, you'll know that that's really what made the Great Depression last so long and made it so hard to get out, was the protectionist measures were huge that took place in the 1930s.
Thank you. And just to follow up on that, I think if I'm understanding correctly, the longer there are challenges and people are concerned about
Yeah.
the pace of global growth, the more those tendencies can come up to
Yes.
bring in protection policy.
That's right.
Thank you. And if I can...
Yeah, absolutely. Go ahead.
I think during the presentations you made last week to the Senate and parliamentary committees, you spoke about some of the uncertainty about how the fiscal measures that the government is bringing in will flow through to consumers, and whether consumers that are carrying more debt than they were in the past will actually spend that money
Right.
to have the kind of impact that the government has forecast. Can you speak a bit more to that? Is there a real risk that that forecast just won't be met, or?
Well, it's one of the risks that we analyze at the end of the monetary policy report. It's about the household saving rate. So it doesn't talk, I don't think, specifically about specific fiscal measures, but in this context where there's enough uncertainty and you have, frankly, consumers in Canada have done all the heavy lifting over the last few years to keep the economy on a reasonable growth track. Exports have been lackluster, investment has been lackluster. So they've borrowed a lot, they've bought houses, they've bought cars, etc. And so it wouldn't be surprising at all if they took a breather. And so that is built into our forecast, if you like, a breather. So a period during which there's much less growth in those parts of demand because people consolidate, they pay down their debt, that kind of thing. But that's, the episodes like we're dealing with have hardly ever happened. So we can't rely on, it's not a small change. We've been through several years of extra consumer spending and borrowing. And how people will make the plans for the next few years is certainly a question mark. Our models can only tell us so much. So it's in that context that some of the fiscal measures are directed at the consumer, at households. And so with that mindset, you have to be, cautious in predicting how big of an impact a certain fiscal measure will have once it goes into that household and they decide what to do with that extra spending power. Save it, delay it, pay down their debt, or spend it. And so that's why we talked about the fiscal measures which were on infrastructure are much clearer, because in that case, if you put an infrastructure project up and running, the people get the job to dig the holes and build the thing, and they get paid and they spend it because it's income. It's not a little extra income for a household. It's different. So the multipliers are always bigger for those things and smaller for households and more uncertain for households. So as I said, we've taken, I think, very reasonable estimates. They're careful estimates. They don't assume huge numbers. But of course, it remains an open question, so we analyze the risk in the back of the MPR.
Greg?
Good morning. You mentioned that monetary policy can lose some power as rates head lower and lower, and maybe through zero. Juve, can you give us any sense or estimate of how much less of a boost there would be if interest rates in Canada went towards zero or even negative?
No, I can't, Greg. The experience with these in this neighborhood is very limited, and so it does appear from that experience, which is not a lot of on which to base true empirical work, but a more let's just say an interpretive consideration of the data suggests that there are effects, positive ones, to these policies. But bear in mind, for example, in the past year, you've been also seeing somewhere the effects of lower energy costs also boosting, purchasing power in most economies actually. And so there's a lot of analysis going on now, like where is the impact? Because the world uses energy, therefore lower energy costs is supposed to be like a reduction in the tax on growth. So you will get a positive effect eventually, but some of it has been harder to find than in the past. And so no doubt these things are kind of mixed up together, like in Europe, for instance. So economists think, yes, there's an effect from lower oil prices. Yes, there's an effect from negative interest rates. But both of those things would look the same, perhaps, right? So anyway, and is the banking system up and lending again? Yes. So there's several things happening at once. You can't disentangle without a longer period of history, and I certainly hope we don't have one, that things will recover enough that this episode is behind us in time. But anyway, the short answer is no, but I hope that helps you understand it better.
There's been a perception, I would say, among economists that if the dollar moved much higher, it could really choke off Canada's recovery. You used the phrase again today, but the icing on the cake, that most of U.S. power exports might in fact come from U.S. demand, and the dollar might not be important. But rate for us, a higher dollar would have some impact, but is it something you're really that worried about?
Well, we acknowledged in the last NPR that our assumption for the dollar had gone up by 4 cents between January and April, and that 4 cents had to be taken into account. That's how a forecaster does it. That's a negative shock to the forecast, all other things equal. But of course, it didn't come all by itself. It came along with higher oil prices. So the link between oil prices and the dollar is alive and well. And when we were down at around 67, 68 cents, and the oil price was 27 or 26 in that neighborhood, and we've had something like a 15% move in the currency, and we've had, well, I guess about a 50% increase, give or take, in oil prices. So the rule of thumb that we've always carried in my head is that around a $10 change in the price of oil can give you something like 2 to 3 cents in that chart, which is the dollar with the oil price. They're like train tracks on average. So that relationship is roughly what you would expect based on what oil prices have done. So of course that means there's extra income coming into Canada from $40 oil than there would be from $27 oil. So that's pretty important. Oil price companies have told us that's fine, but that's not going to cause us to change our investment plan. In fact, we're still planning to cut further this year than we said before. So that was the second negative shock that we had to take on board. So yeah, the dollar has that effect, but it never happens by itself. It's always something else. So yes, there's a positive related to oil prices, negative perhaps coming from the rise in the dollar, and those go into the mix, and we redo our forecasts, and all those things are taken into account in that rich model that we use.
And we have time for one more. Jonathan?
Follow up my friend here, this question on Canadian consumers. You have, I think, 3 years for the Canadian economy to recover from the oil shock.
Yeah.
But with consumers carrying such high levels of debt, can they really wait that long, even if some of these budget measures, play out in the best case scenario?
Well, I think what's important to bear in mind is that nobody's waiting, and the economy will actually look like it's recovering anyway. What we're saying is that under the surface, you've got this negative force, which is the adjustment to lower energy costs, and that's one track of the economy. Another track of the economy is responding quite well to the U.S. recovery and to lower Canadian dollar. And so those two things combined are giving us a recovery scenario for the macro data. So people won't be waiting for that thing. I mean, of course, people who are directly affected within, say in Alberta, they need to adjust. Companies and workers alike need to adjust to this new regime of lower energy costs. So I don't want to minimize that from an individual point of view. But it's not like the economy is doing nothing for those 3 years. There's an important track of the economy, which is finally getting its momentum up. And so when we add it all up, there's that good chart in the monetary policy report that shows that 17% of the economy, which is related to non-energy exporting, is growing at the high threes, close to 4%, and that then the energy economy is shrinking by about 4%, and that's I'm forgetting 14%. And so the remainder of the economy is 69%, and it's growing at about 2%. So the negative and the positive are kind of offsetting each other roughly and giving us something close to 2% growth. The negative will at some point bottom out, which probably later this year, and then only the positives can be contributing to growth. And so that's why we go above 2% growth during that transition. And new jobs are being created by that other track of the economy.
That's all the time we have. Thanks for coming.
Thanks very much.